to. This is Jonathan Mickles with the Strategic Multifamily Investing Podcast, and today I have with me Mr. Jeremy Friedman. How are you doing, Jeremy?
Hey, I'm doing great, Jonathan. Thanks.
Excellent. So your team sent over a long list of things that you have accomplished in your career. So let's kind of start where you are right now, and then maybe we'll go back. What kind of investing are you doing now, Jeremy?
Yeah, so it's funny. I always talk about my career as my 3 lifetimes. So they're pretty varied, but they all have led me to where I am today, and that is with Stoic Equity Partners. Co-founded Stoic Equity Partners back in 2020 as a private equity real estate company to at the time to invest in self-storage assets. So we would raise money, buy self-storage, and manage it, manage those assets. We have a third-party management company that actually manages each property. But we did an adaptive reuse of an old grocery store box. We bought a pretty stabilized property that we implemented a value add strategy on. We expanded, actually tripled the size of a facility up in Little Rock, Arkansas. And then we did a ground up development in Pensacola. So kind of all the gambit of self-storage. But the common thread there is we had to do some real heavy value add lift. And as interest rates were rising, we even found that was not getting us where we needed to be on returns. So we pivoted to multi-tenant value add flex industrial properties, which, to explain flex industrial, this is what we call the mullet of commercial real estate. It's business up front, you've got office or showroom, and you've got roll-up doors and dock highs out back. So it's just typically a office warehouse park with, say, the sweet spot's probably like 3,000 to 5,000 square foot suites in a multi-tenant building, usually, or buildings. Usually it's somewhere in the 50 to 100,000 square feet. So we've been focused on flex for a couple of years now. Total portfolio size at the moment is 89 million. 30 million of that is outside equity that we've raised, starting with syndications early on. Now we're raising and deploying our first fund. That is 13 properties in 6 states around what we call the SEC region. So Alabama, Georgia, Mississippi, Florida, Kentucky, and Arkansas is our current footprint. So that's what we do now, and it's a very exciting time, and we love it.
There's a ton of questions that I've got as a result of that short introduction here. So let's dive in. You started in 2020. That's pandemic time. Help me understand.
Exactly. So my partner and I were both brokers at the time, commercial real estate brokers. And the phone stopped ringing just long enough for us to hatch a plan to start Stoic. We had both worked together at a previous brokerage years before, had stayed in touch, had always wanted to get over to the principal side of things. And the phone stopped long enough. There was a lull, just long enough for us to hatch the plan. I like to say we're a Stoic baby. COVID baby.
Sorry. A COVID baby doing the Stoic. Yeah. And so where did the name Stoic come from?
So Stoicism is one of our 4 core values. And Stoicism, for those that don't know, was a philosophy from thousands of years ago. But primarily the part of Stoicism we like to lean on is that, you cannot control what happens, and you certainly cannot control what happens in a real estate transaction or investment, but you can control how you react to it. And so Stoicism, we felt, was a particularly interesting philosophy to use with real estate transactions and investments, because, as you know, anything that can and will happen happens in a real estate transaction. And if you can keep a calm head, if you can stop and and control your emotions and control how you deal with the situation, you can typically have a much better outcome than those people. There are a lot of people out there that react without checking their emotions at that time. So,
And I'm
that's where
sure that was a hallmark of Grant, I believe it was, is your co-founder.
yeah, Grant's my
That you
co-founder.
and Grant shared at that time, or just, over time. So you kind of saw that in each
Yeah.
other. So how do you build, I want to hear about the other four values, the other three values that you have, but how do you build a stoic mindset? I mean, is there some daily things that you do, or, was there, life principles that came out that help you to exhibit that as you all operate the company Stoic?
So, you know, um, I like to read a lot of the Stoic literature. I like to listen to some podcasts and readings on Stoicism. Marcus Aurelius's memoirs or meditations that he's written, which is particularly helpful. Um, and it just is a mindset of um, doing the next best thing, not reacting and not letting your emotions get a hold of you. That's when you can react in negative ways or let your ego get involved. But taking that time to meditate on what is the next best thing to do to get to the outcome that we want, right?
Yep.
It's always important to focus on what is the outcome we want. It's real easy to get distracted by the steps in the way and the roadblocks in the way, but it's about what is ultimately our goal and what's the next best thing to get to that goal.
Excellent.
So
So your other three values for Stoic, other than
yeah,
Stoicism, what else do we have?
well, so lifelong learning. So there's I think now more than ever in our world, there's new information, new process, new tools that can be used, and I think that you have to have the right mindset of always evolving your process, your tools, your plan, right? And so lifelong learning, pursuit of excellence. That's pursuit of excellence, not excellence, because I think it's something that requires daily work. And so pursuit of excellence, and then finally, but not last at all, but stewardship. We deal with other people's money, other people's investments, and so we take it very seriously. And we don't, our first question is not what's best for Stoic. Our first question is what is best for our investors, our partners. And so those are our four values. So I'm
That's
glad you
really,
hit on them.
yeah, no,
That's
that's really key, especially if you're looking for a partner to invest in the future. You want to
yeah.
know how they think, where are they coming from, so that you can judge the communications that you have from thereafter to see whether or not they actually live up to those particular values. And I can see that you definitely have gotten the second one right in terms of lifelong learning, because you started out in, just doing, storage units. So help me understand, how did you come to doing storage in 2020?
Well, that's a really good question that has a lot to do with COVID. Our first property that we did was actually, we put it under contract twice, and the first time we put it under contract, it was an old grocery store box, 45,000 square foot box that had been converted into office space. And during the Great Recession, the grocery store went out. It got converted into office space. And our very first plan was it was a big, nationally, or a big publicly traded company. Our first plan was to have them extend their lease and then turn around and sell it at a lower cap rate. It's very fundamental, very basic plan, right? Well, it started off well until about the third third meeting we were having with the tenant to negotiate this lease extension. And we walked in and there was nobody in the office. And
Yeah.
if you can imagine what happened, COVID happened. Someone from their team brought COVID back in the office. It ran through the office a little bit. They sent everybody home. They're a medical technology company. They always knew that at some point they wanted to go to some sort of a work from home model, but felt like HIPAA laws were going to prevent or slow that process down. Well, all of a sudden they had to make that change, and they did, and it worked. And now all of a sudden they said, hey, we don't need the office space. So it totally ruined our plan, canceled the contract. But part of the space was not built out as office, and we had always had a little plan that maybe we could turn it into climate control self-storage. And then the broker who had the property mentioned, hey, these guys kind of want out of their lease. Is there, they could maybe buy out of their lease. So we went back and we came up with a whole new plan. We negotiated with the tenant for them to buy out the remaining term of their lease. Instead of extending it to 10 years, they bought their last 3 years, paid for it. We used that as part of the equity in the deal to go in and convert it all to self-storage. So
wow.
That was, and really what made us decide to do that. Part of what just made us decide to do that was we had a third-party management company out of Birmingham, Alabama called Stoic that virtually manage properties. And so you can lower the operating expenses on properties. You walk in, I kind of like to equate it to more of an Apple store feel than a self-storage facility. You walk in the front door and there's a big screen. You got gleaming white tile everywhere. You got a big screen and a live person. That's their differentiator. They have a live person comes on the screen and says, hey, welcome to Stories. How can I help you? And they walk you through the leasing process. And then all of our locks are smart locks, and they have their Bluetooth off of smartphones. So this solves a lot of problems for us as, people don't pay their bill. They show up, they can't get in the building. And then it says, hey, you haven't paid your bill. They pay their bill, and all of a sudden, boom, they can get in the building. Some things like that help automate the system. And so that helped us kind of, find that niche for us to get into the market. And then, like I said, we did 3 more of those after that one. And then ultimately,
and that's COVID, I guess protected, because again, while there's a live person, that person is not in person. So it's right. Easy for you to be able to get that going. So you learn, again, you were, that transaction went kind of crazy, went sideways very quickly with 3 times. I can imagine that was, wrecking your brain. So what made you choose locations? I mean, because as I'm looking here at some of the places you're in, Alabama, you say Mississippi, I think it was Kentucky or Kentucky, I think it is.
We're in Louisville, Kentucky. So the common thread with all of our investments is we're in the Southeast, or what we call the SEC region. And we are there because growth, population growth is driving all of those decisions. And so you've got a pretty big net migration trend going on from the Northeast down to the Southeast. You've got a lot of business-friendly municipalities and that are allowing a lot of growth to occur. They are enticing. You mentioned you're in the Piedmont area in North Carolina, and they're enticing these automakers or battery manufacturers. All of that is happening more and more in the Southeast than other parts of the country. And so we're seeing a lot of growth, i.e. demand, which is what ultimately drove us to the flex industrial side, is that we really liked the supply and demand components of that asset class, because as the markets are growing, there's a need for businesses, new service-based businesses to serve that growing population, and they need somewhere to be and somewhere to call home, somewhere to locate. And flex industrial properties have not been built in any meaningful volume in the last 30 years. And so what we've got is a very stagnant supply, a growing demand, and in a lot of cases, the rents that we're able to achieve currently aren't high enough with current construction costs to warrant new construction. So we're able to continue to see this strong demand, low supply. We're able to raise rates, but we know that eventually there'll be enough demand, people will have to build. And when they do, the rates will be even higher, and that'll help buoy our rates and make it help us to continue to raise rates and see good continued returns on our products. So,
Yep.
So the common theme is growing markets in the Southeast.
Got it. So rising tide lifts all boats. You mentioned, market trends and market data. I've used the U-Haul annual report of where people are traveling to as a way of being able to determine where jobs are. What are some of the sources that you use to do some of that market analysis?
We typically look at just look at the demographics in an area, the population growth. So it is important to note that, say we're in Jackson, Mississippi, we have several properties around Jackson, Mississippi, but in that market, we look at where are the growth pockets in that market, because typically those business owners that own these service-based retail or service-based businesses, they typically like to work near where they live. They want it to be convenient. So we look at the growth in the markets and find those areas and say, hey, this is where we're going to see the strongest demand for our space.
You mentioned earlier that you started off in the self-storage space, and while you do see that there's going to be some growth, you found your home in now the small light industrial flex space. What was it that you saw in that data and in that research that told you that's the better place to go right now?
So it was simply supply and demand. So when you look at supply, it's the one asset class that has actually shrunk in supply over the last 30 years, and that is the flex industrial space. So while in the large, class A bulk and distribution industrial, that has grown in supply. The smaller suites, the small bay, shallow bay flex has not grown. And so, but the demand has. And so it's just an interesting dynamic that we don't see anywhere. And it's the opposite of what we were seeing in self-storage that made us want to pivot. So self-storage, I think probably everybody listening can agree that they see self-storage popping up everywhere. And so what you've got is you've got a lot of supply. There's a very low barrier to entry. About the only barrier to entry for self-storage that exists is entitlements. So if you're in an area that has figured out or has decided that they don't want any more self-storage, then maybe you're pretty well protected. But most places, you'll see them pop up everywhere. So you got a lot increased supply. While during COVID, there was an increase in demand. Since then, especially as interest rates have risen, people are not moving around. They're stuck in their home because they've got a low interest rate. I say stuck. I mean, they're happily stuck in their home.
3% is a good motivating factor, right?
Exactly. So why am I going to go buy less of a home at a higher interest rate when I can stay where I am? So what that did is all of a sudden it put the brakes on demand for self-storage, which has subsequently started to work its way into rates as well, rental rates. So kind of the opposite is happening in the flex industrial world. We are seeing some new developments starting to pop up here and there, but by and large, they are, it's a pretty stagnant supply and there's increasing demand. We like that. We like that imbalance much better than the opposite, what we were seeing in self-storage.
So since you look at all asset classes and, this podcast is generally, pivoted towards multifamily, what did you see in multifamily that made you say, we'll stick with this other pivot point?
So multifamily has always been very interesting to us, and we do think of Stoic in a lot of ways as potentially a portfolio manager of real estate at some point. Um, we are focused on flex and have that experience and that expertise that we're working on. But multifamily has always been interesting to us. One, it's probably the biggest way to deploy capital, which I think is always interesting. It's a very large asset class. Supply has increased, but I think when you look at the amount of housing demand, I think fundamentally multifamily is got a long runway. Supply of housing units period in the United States, we're cut down to 1/3 of what the previous supply during the recession, and it's never really rebounded all the way back. And so it's interesting what's happening right now. There's a huge demand for housing units, as we've seen, but because interest rates have risen so high, and we're seeing that again. The supply of housing units is going back down. It's going to do nothing but continue to push that down the road. There's going to be long time demand. For us, multifamily buying at a low cap rate with the anticipation of exiting at a low cap rate was the thing, usually an even lower cap rate. That was the part that kept us from jumping into multifamily.
Like, can you compress the cap rates even more than what they already right now?
Right. And then especially in an up interest rate environment, right?
Yeah.
So to put that in perspective, we're buying most of our flex in the upper 7% cap rate range and looking to exit in the 8% cap rate range. So we're not looking to compress cap rates. We're not buying a in place 4 and hoping to get to a 4. So that was kind of what ultimately we said. It's just not, for us, didn't seem like the right time to enter multifamily, especially in an uprate environment where a lot of people are working off bridge loans, and then you take. There was such an increase in rental rates during COVID. We started looking at that and we said, well, while we think the demand is so strong long term, it's going to be fine. We just thought that maybe the next move might be either a horizontal move in rental rates or possibly a little bit down. And we just didn't feel like we could continue to underwrite increased rental rates over the next few years, whereas the opposite had not occurred in flex yet. So those rates didn't run up, and partially because we have in flex, we typically have somewhere around a 2-year WALT or weighted average lease term, meaning people are signing a 3 to 5 year lease. So there, you don't get that opportunity annually like you do in multifamily to reset rental rates. And so we kind of saw the fact that, hey, we're going to get to reset rental rates because it hasn't occurred yet.
Got it.
That was the other thing about multifamily. Felt like rent rates had jumped up, and didn't know that we could continue to see increased rates, positive rate change moving forward.
I know I've heard from some gurus, if you will, that they expect rental rates to double in the next 10 years. So they've been encouraging everybody to kind of get into single family. But again, if you don't know, then, and you're not really looking at whatever trends or information that they're looking at, you can just stick to what you know. And obviously you all have done your homework in this space. So if it doesn't feel right to you, and I'm just sharing that also with those that are
Yeah.
listening. If you can't, square the circle, then don't do it. You need to understand everything that you're getting involved in. You need to stick with somebody who's a leader. I'm sorry. Go ahead, Jeremy. You had something to say.
No, I just wanted to clarify. Long term, I think multifamily is an incredible asset.
Okay.
I just felt like that was not the right time for us to enter that market, and I felt like there was going to be some short term challenges. Now there there are some short term challenges right now in every asset class, I think,
Yeah.
but multifamily was one that we felt like was just not the right time for us to try to enter that market.
Gotcha.
So,
So I've
but
got,
but there are a lot of parallels in a value add multifamily property and a value add multi-tenant flex industrial property. I mean, it is the same play. We buy it with below market in place rents. We renovate. Now we're not putting in new granite and new LVP flooring, but we are usually putting in new LVP flooring in the offices and things like that. But it's a little different. We're renovating, and then we're increasing rents, and then we're looking to sell it down the road at a higher price. So it's a very similar play. I mean, it's
yeah.
the same play, honestly.
Yeah, it's just
The
a different
difference,
asset class.
yeah, it's a different asset class. A lot of the differences come with the leases. So we're negotiating longer
You're doing
term.
triple net leases on a longer
We
term?
most of our properties we do triple net leases or some variant of that, and we're doing longer term leases, and we're typically negotiating with more sophisticated, a lot of times national credit tenants, and so that becomes a difference and a challenge. A lot of times we're having to pay tenant improvement money to the tenants for them to like an
Okay.
allowance for them
Okay.
to customize the space for their needs, which we find makes them a stickier tenant and it gets us higher rent. And so we like doing that. A lot of the sellers of the product are not doing that. So that's one differentiator for us. But again, it's still buy a building with below market rents, fix it up, jack the rent, sell it. It's same play.
Same play. So
Yeah.
I got a real simple question, then I've got some more stickier questions, I guess, down the road. So in going, you mentioned that the demand for this flexible industrial space is going up. Is that because we're seeing more manufacturing coming to the US? I mean, what are some of the things you think that are causing the demand to increase?
So it is partially the inshoring and nearshoring of manufacturing that's been going on, because it does create it creates needs for service companies to service those manufacturing facilities, right? And but it's also the residential population growth and the HVAC contractors or pest control companies. Those types of service-based companies need to service the population growth as well, and so those are it's both. We are seeing interesting, and I'm bringing up Jackson, Mississippi again, but in Jackson, Mississippi, recently there's been a very large data center announced by AWS or Amazon Web Services for that market, or north of Jackson in the Madison County market. And so the amount of inquiries right now coming off of mainly contractors and service providers for that project is just unbelievable. And so, and there's going to be a lot of that demand, with AI, there's a lot of data center demand out there.
Yeah.
So that's kind of some more industrial growth and on top of the current inshoring and nearshoring going on. So yeah, it's all of the above. I mean, it's just demand is good. We're very, very pleased with demand.
Excellent. A couple more questions, and then we'll just land the plane here on this one. I know I've been asking you some pretty in-depth questions. So you mentioned earlier in your conversation about how you all grew from syndications to doing more, doing a fund. What's the difference in that, how you were doing that before? Because you were doing 506c funds, or syndications, and now you're doing funds. Help us understand that progression and what's the difference?
So originally we were doing a 506B
Okay.
because we were not doing any general marketing or solicitation. We were only talking to our network, i.e., friends and family network, right?
Right.
My Grant and I both were in investment sales and commercial real estate. So we have a pretty good Rolodex of people already known to us that want to invest in real estate. And so we were syndicating, and what we were finding, the reason we made the switch to a fund is that we found that it was very hard to solicit new investors to go talk to people and develop our Rolodex. So it kind of had us pigeonholed in this certain size of asset, right? Because that was the amount of equity we were comfortable raising. So we would get that size asset under contract. We would then put it out to our network, and it would get gobbled up sometimes as fast as one day. We would sell all the equity, which sounds like an amazing thing, and it was. And I don't mean to complain. Don't mean to complain about it. But what happened is as we would go try to meet with new investors, sit down, tell them about our program, tell them what we're doing, and of course, it always came back to, well, do you have anything to invest in right now? Well, no, not yet, but we'll let you know the next time we do. And then the next time we do, it gets gobbled up by the guys who are doing it. So it was really like it was very hard for us to expand our database doing that.
Before you keep going, I'm sorry, just one quick. How large was your database at that time?
So I would say probably it depends on how you're at. I'm trying to figure out how to answer this. So it was a couple hundred investors, of which more like 30 to 40 of them were active. Okay.
That's perfect.
Which makes sense. It's like
that's
the 80-20 rule, right? All right.
Yeah, that's perfect.
So hindsight being 2020, we probably should have switched to a 506C and continued syndicating. But what we decided was a fund would give us the opportunity to have a longer time horizon to raise funds, right? So we switched to 506C. We launched our first fund, SqFt Industrial Holdings 1, and we started raising for a 12-month raise and deploy, right? We were going to raise and deploy at the same time. 12 months, $25 million was the target raise. We are 8 months into that raise, and we have, that's not true, not quite 8 months. That's 7 months into that raise. Anyway, what, 7, 8, close enough. 7 months into the raise, we have raised $7 million. That's $8 million into the fund, and then another $9 million alongside of the fund to invest direct into assets. And so what's happened is we've raised $17 million of the 25 we wanted. It just didn't all go into the fund. What we've learned is that
pause 1 second. I mean, I'm just a little confused. So if you've raised $8 million in the fund, you said another $9 million alongside the fund. What do you mean alongside the fund? I mean, if you have the fund and you're raising,
this is something I wish somebody had explained to me before, because hopefully this helps somebody out there listening, because what we found out is there are a lot of larger check writers who are, especially with what they would call an emerging sponsor like us, that are not interested in putting their money into a fund. They'll gladly invest in a single asset. So what we would do, and currently the fund owns a portion of 3 assets, and then some outside check writers also own a portion of each of those 3 assets. And so it's almost like a syndication where
Exactly. I got it. Yeah.
one of the
Because
LPs is the fund, right?
yeah,
That's kind of what the way it's turned out.
right. The LP is a fund. The LP is some combination of the fund and maybe the larger check writers.
Yeah, so like we'll have one deal and it'll have a large check writer and the fund in it. They're both common equity. They're both treated
As
essentially
LPs.
the same.
Yeah.
But it's very interesting, right? And so we're still working this out. We don't know if the fund model is the right one for us, if we will kind of pivot to go back to syndications. And but what we do know is the 506C was the right move. It allowed us to do some actual solicitation, general marketing out there that has attracted a lot of new investors to our database, which is now numbers in the thousands of investors. So
Gotcha.
but we're
what's the minimum contribution that you're taking in your fund?
The fund minimum share is $50,000.
Okay.
So it's very approachable. I would say the average check size in the fund right now is more like closer to 150 to 200.
Mm-hmm.
But minimum is 50.
Mm-hmm.
We have some some larger check writers in the fund.
Right.
And then we have, some investing alongside the fund in our deals. So,
right. Yeah. I mean, from what I understand, we did an interview with Kimley Taylor from Syndication Attorneys, and she's she's the SEC attorney, and we were talking about just kind of the numbers on average, what type of deals are being done, just by the numbers in general. And so from SEC filings, from what I understand, 506B still is the king of the type of filings that most people do. The 506B is a friends and family, as you mentioned. But of course, a lot of people like yourself are doing 506Cs where they can, advertise to the public. Most of them have no more than, a couple 300 people or so in their database, of which about 50 or less, 30 to 50 people are investing. Yeah. So, I mean, everything that you said has just been right along the, and the check sizes, generally, if you're a new syndicator or an emergency syndicator, a new operator, you'll get a $50,000 check initially. But then as you move on, the average check size is 150 to 200, as she mentioned. So this is kind of going right alongside, what the averages are per our conversation. So that's great that you're getting that. Is the fund still open?
The fund is open until November of this year.
November 2024. So by the time this is going out, we'll probably be getting close to the close of the fund, but reach out to Jeremy anyway. You never know. I mean, there probably is going to be room to do some other things moving forward. Go ahead, Jeremy. You had something else?
The benefit to the investor for the fund is they get one federal K-1 for multiple assets. They get that diversification across both properties and geographically. I mean, the fund currently owns some amazing assets, one in Louisville, Kentucky, one in outside of Atlanta and McDonough, Georgia, and then one in a little portfolio outside of Jackson, Mississippi. They're all doing well. And so, I mean, the benefit to the fund, and the reason we may continue to do a fund, may do a second gen fund, is, it allows people that want to put 50, 100, 200 in and be diversified without having to pay attention to each and every offering that comes out. And do I want to get in this one deal, or if I get into this one deal, and it doesn't go, the greatest. How do I diversify? And so
You get to balance your risk. You get to balance out whatever your risks are. So the fund is able to take on a little bit more riskier things at that time and have it balanced with, very solid other items. Because sometimes there just are deals that just go wrong no matter what. And so
well, the interesting thing, what we've done with the fund, and this was intentional. We have mixed some properties that are higher cash flow centric, and then with higher value add centric. So what you have is, these couple properties over here are going to churn out, a 7 to 8% return. Doesn't have a huge upside. That's cash on cash, so 7-8% cash on cash, but maybe they only get up to 15. Then you've got this over here, maybe you're going to average cash on cash in the 5% over the whole period, but it's hitting a 19 IRR. So you can kind of blend those together and build a portfolio that really hits all, has cash on cash returns as well as higher upside. So
gotcha. And the higher upsides are generally when you're going to refinance in 5 to 7 years, depending on whatever.
Well, our whole fund is 5-year hold period.
Okay.
So we'll sell them all within 5 years. But the higher returns is, for instance, that one out in McDonough, Georgia, we bought that property at an average of $63 a square foot, which is extremely low. In-place rents were $5.03. Average, and that was a gross lease. We're already signing renewals with existing tenants at $12 net. So to give you an idea of how much upside was in that property.
That's upside.
Yeah, that's upside. Now, because it's got low rents up front, the first year there's like no cash on cash.
That's the one you want to be in right there. I mean, if you've got $5 gross per square foot, and now you're talking 12% net per square. That's going to be $12 net,
triple net, and that's annual. I know you multifamily guys talking monthly rents, so that'd be $1 a square foot monthly, right? But it's triple net. So they reimburse us for property taxes, insurance, and common area maintenance. So, so they went from $5, or I guess what would that be, about 40 cents gross, up to $12 or triple net. So it was a big jump, and they're I mean, they know that's the market. So it was just a really below market rents, and so very heavy value add lift on that property. So we've got a higher return, higher IRR on that one, but
absolutely
lower cash on cash return.
But I think it's going to be successful. It sounds like it is. I keep saying two questions, and I want to honor your time, but you keep saying some things there's some more questions that keep popping up. But not every investment is going to have be that's a home run. So I'm pretty sure you've encountered some challenges. What are some of the challenges that you are seeing right now within the industrial space, or even within short-term storage that you're seeing? What are some of the challenges that you're facing?
So one of the biggest challenges we're facing portfolio wide is insurance. So especially in our coastal properties, I'm on the coast of Alabama. I'm on the Gulf Coast of Alabama, and we have several properties here in Florida and Alabama along the coast. And insurance has, in some cases, quadrupled in the last 3 years. And so with self-storage, that's particularly painful because those are gross leases. And so that's just strictly coming out of our net operating income. With the flex properties, while they are net leases or some version of net lease, they have that puts a kind of a cap on what the tenants can pay for their base rent, because they're looking at their total rent payment, and that includes reimbursements and CAM and their base rent. And so that becomes a challenge when they're we're having to hit them with increases in their CAM. It's tough. So property insurance, property taxes, it's not uncommon in these growing markets, values are increasing. So therefore property taxes are increasing. And I think a lot of, I know a lot of the insurance rate it's not so much, it's not only the rate, it's the total insured value that the insurance companies are willing to insure the properties for because of inflation, and the actual replacement value
That's exactly what I was
has
going to ask.
gone up
Yeah.
tremendously. So now we're in most cases, I mean, we're buying, part of our thesis is we buy below replacement value. So, and now if the insurance company is saying, oh, well, you got to insure it to replacement value, and you got to be careful because there's usually co-insurance clauses in there, and if you don't insure it to replacement value, there can be some severe penalties if you ever need the insurance. But anyway, so because of inflation and replacement costs has gone up, that part of the insurance equation, I don't know if that we're going to see any relief from that. I mean, we don't expect construction costs to come down to anything meaningful moving forward. Matter of fact, just the opposite. It's kind of part of baked into our whole philosophy. So insurance is probably the biggest thorn in our side. We look at we spend a lot of money on insurance annually. And so we've looked into putting together our own captive. We've tried to put,
I'm sorry. What is a captive? What is a captive?
Captive insurance is kind of like forming your own insurance company.
Gotcha.
And so you still go and you buy the reinsurance, but you put together a pool of reserves to cover first losses. And it's basically like building your own insurance company, which, has benefits long term. In other words, once you build up those reserves, then, next property to you still have to buy that reinsurance policy for the major losses, but you don't need to pay in too much for the reserves. Or when you sell a property, you can return some of those reserves back to that property, things like that. So that's one way we've looked at master policies. But then you got these coastal properties, and then you got these inland properties, and we don't want to drag down this inland property with the coastal property. So it's very challenging at the moment.
Do you, as an operator, two things? Do you have flood insurance as a part of your insurance packages or your riders? And then number two, for I guess I'm going to say just storage unit tenants, but I would say for all tenants, having flood insurance, having them to do flood insurance, if you will, to be self-insured in addition to what you're doing.
Well, if we are in a flood zone, AE or some flood zone,
or coastal property,
well, coastal properties still, you've got some that are in AE or some that are in V. But if it's in an X or an X, especially X unshaded, we will not. We don't buy flood insurance unless we see that. Even though we're outside of the flood zones, if we see a particular risk, we do have some flood insurance on properties that it's not required, but not many. If it's not required, we don't really see a need for it. The tenants for storage, we require them to either buy an insurance policy through our provider for their contents, or prove that their contents are proven or insured by their homeowner's policy, which a lot of them are. And then for our flex industrial properties, all of the tenants are required to have insurance on their contents, as well as workman's comp and all those types of insurance. They're required to also have those policies in place, and general liability and all that good stuff. So
Got it. So the last question. This is the last, well, second to the last question. I got two more. I don't know. I always got two more. So you're currently raising still for the fund. How can people get in contact with
man, I'm very easy to get in touch with. My email address is jfriedman@stoicep.com, or they can go to the website StoicEP. That's for equity partners. So STOICEP.com. They can find me there. Sometimes I'm active on LinkedIn. Haven't been so much lately, but but they can find me on the website easy. And I'm, as you can tell, I love to talk about real estate. I'm just a real estate nerd and really enjoy it. So, and I appreciate you having me on. It's been a lot of fun.
Absolutely, Jeremy. Same here. So we have one tradition for everyone who comes on. We want you as the guest to give us the boot. That's the one piece of advice that you would give to someone right now to do the next thing in real estate. Give us the boot.
Give you the boot. Give you the
piece of advice that's going to spur us on to the next course of action.
Okay, I like that. So general advice, I guess I would say pay attention to the macro trends. Figure out what is going on. Interest rates, which, by the way, I think we're in a long up rate environment for many years. If you look at the long-term trends, not to say that we're not going to go up and down, but I think the overall trend is up. The same with inflation. Look at, migration trends, population trends. Study the, study the generational habits of the next generations, and what demand, or what is that going to create? Where is that going to create demand? And I think multifamily, especially, I think if you start studying the habits of these younger generations, and as they're coming up, and what are their desires, their wants, where do they want to live, what are the amenities they want, all these types of understanding these macro trends. I think that, to me, has the ability to guide all of us in our career, and where we'll be successful in real estate.
So were you a CCIM or on that track at one point?
I have completed a couple. Yes, I was on that track as a broker. Did not finish my CCIM. I was actually finishing 102 when I switched over to Stoic, and haven't had found the time or the need or desire to finish that up. But
I certainly understand.
CCIM,
yeah, CCIM, for those who are listening, is the Certified Commercial Investment Member Certification. And I believe a couple of courses in there are specifically about how to go and find out what those trends are that you just mentioned, and maybe put them into some sort of a model that will help one to understand where the trends are going and how those trends are going. And so that's, as you were talking, that just came up in my mind. I thought maybe that'd be something to recommend as well.
Yeah, I think it's very important to, we all, as real estate folks, we tend to put our head down and focus on either our geographic market, or our asset class, or kind of get really focused. And I think it's important to stand back and look at the world as a whole, and that helps us understand the big trends and the big market and the big picture. So
perfect.
That's what I would say.
Thanks so much, Jeremy, for your time. And this has been excellent. And we look forward to working with you all in the future. If there's anything that we can do for you here, please feel free to reach out and let us know.
Man, thanks, Jonathan. It's been a blast. It's good to meet you. I enjoyed it.